Imagine waking up tomorrow to discover that trillions of dollars had been created overnight, not earned, not produced, simply created. Now imagine something even more surprising. Not everyone receives that money at the same time. Some people receive it first, others receive it months later. Millions never receive it directly at all. Most people believe inflation begins when prices rise. Architects know inflation begins the moment new money enters the system, long before groceries become expensive, long before housing prices explode, long before headlines acknowledge reality. Because money does not spread through an economy like rain, it travels through invisible channels, following banks, credit markets, governments, financial institutions. Every stop along that journey creates winners before it creates losers. This invisible architecture has existed for centuries, yet most people have never heard its name: the Cantillon Effect. Today, we decode why the first receiver of money almost always gains the greatest advantage, and why understanding this hidden mechanism changes the way architects build wealth. Most people imagine money as something fixed, printed, counted, stored inside vaults. But modern money behaves very differently. Most money isn't printed, it is created. Created through lending, created through credit, created inside the banking system. Every time new credit expands, the money supply expands with it. Notice something important. The new money doesn't suddenly appear inside every wallet. It begins somewhere. Inside central banks, commercial banks, government spending, corporate lending, financial institutions. Only then does it slowly move through the rest of the economy. Imagine pouring water into one end of a river. The communities upstream receive it first. The communities downstream wait. The monetary system follows exactly the same architecture. Money always has an entry point, and the position closest to that entry point carries extraordinary advantages. Because prices have not fully adjusted, assets have not fully repriced, markets have not fully reacted. Opportunity still exists. Most people believe wealth follows hard work alone. Architects know timing inside monetary systems can be just as valuable. Because the economy is not merely exchanging value, it is continuously redistributing purchasing power. Every redistribution begins with one simple question: who receives the new money first? Imagine two people. One receives newly created money today. The other receives the same amount 1 year later. On paper, they received exactly the same money. In reality, they received completely different purchasing power. Because the first receiver spends before prices change, the second receiver spends after prices have already adjusted. This is the hidden architecture most people never see. Money is not merely a medium of exchange. It is purchasing power moving through time, and timing changes everything. Suppose a commercial bank receives fresh liquidity. It begins issuing new loans. Businesses borrow, investors borrow, corporations borrow, asset managers borrow. That capital immediately starts searching for opportunities: stocks, real estate, private equity, infrastructure, technology, land. Demand increases. Asset prices begin rising. At this stage, most households notice nothing. Supermarket prices remain relatively stable. Salaries remain unchanged. Life appears normal. But beneath the surface, a silent transfer has already begun. The first receivers are purchasing tomorrow's expensive assets using yesterday's cheaper prices. Months later, those higher asset prices begin influencing the broader economy. Businesses experience higher costs. Construction becomes more expensive. Commercial rents increase. Operating expenses expand. Eventually, consumer prices begin following the same direction. Only then, the public starts talking about inflation. Architects know the story started much earlier. Inflation did not begin at the supermarket. It began where new money first entered the financial system. Notice the sequence. Money is created, credit expands, financial assets rise, business costs increase, consumer prices follow, headlines arrive last. Most people study the final stage, architects study the first, because the beginning of every monetary cycle determines who captures the greatest advantage. The Cantillon effect is not simply about inflation, it is about position. Not everyone stands at the same distance from the source of money, and in every monetary system, distance determines opportunity.
The Cantillon effect is often misunderstood. Many believe it explains why prices rise, but prices are only the visible outcome. The real story is the movement of purchasing power. Imagine an economy as a giant reservoir. Every participant holds a certain amount of economic influence, not measured by dollars alone, but by what those dollars can actually buy. When new money enters the system, total purchasing power does not instantly increase. Instead, existing purchasing power begins shifting, quietly, gradually, almost invisibly. The first receivers gain access to goods and assets before markets fully adjust. They acquire ownership while prices still reflect yesterday's economy. The last receivers inherit tomorrow's prices without receiving tomorrow's advantages. Notice what changed. Nobody stole their money. Nobody emptied their bank account. Their currency still shows the same numbers, but those numbers command less value than before. This is why inflation feels confusing. People see the price increases. They rarely see the purchasing power transfers that cause them. Architects understand something deeper. Money is not wealth. Purchasing power is. And purchasing power is never distributed randomly. It follows incentives. It follows institutions. It follows the architecture of money creation itself. This explains why financial markets often surge, even while ordinary households struggle. Why luxury real estate reaches record highs, while wage growth moves slowly. Why asset owners appear to become richer without producing proportionally more goods. The explanation is not always productivity. Sometimes it is position inside the monetary system. The closer capital stands to the source of newly created money, the sooner it begins compounding. And compounding does something extraordinary. Small timing advantages become massive wealth differences over decades. 1 year becomes 5, 5 becomes 10, 10 becomes generations. Most people believe wealth inequality begins with income. Architects know many wealth gaps begin much earlier, at the point where money enters the system, because the economy is not merely rewarding effort, it is constantly rewarding position, and position is designed into the architecture long before outcomes become visible. The Cantillon effect reveals a timeless principle. Money does not move randomly. It moves according to the structure that created it, and anyone who wishes to understand wealth must first understand the architecture of monetary flow.
Most people believe money is neutral. Architects know money follows architecture. Every monetary system has an entry point. Every entry point creates a sequence. Every sequence creates incentives, and incentives shape human behavior. Consider how every economic expansion begins. Central banks lower interest rates, liquidity increases, banks become more willing to lend, credit becomes cheaper, investment accelerates. Financial markets respond almost immediately. Stock prices climb, property values appreciate, business valuations expand, long before wages significantly increase, long before consumer demand fully reacts, long before inflation becomes tomorrow's headline. This is not an accident. It is the natural consequence of how modern money enters the economy. The system rewards proximity, not equality. Those closest to credit receive flexibility. Those closest to capital receive opportunity. Those closest to financial markets receive appreciation. Everyone else participates later, after prices have already adjusted, after competition has intensified, after purchasing power has quietly shifted. Notice what the system is optimizing. It is not distributing money equally. It is distributing liquidity efficiently through financial institutions. Efficiency and equality are not the same objective. and confusing those two objectives creates endless misunderstanding. This is why two people can work equally hard, earn similar incomes, and still experience dramatically different financial outcomes. One accumulates appreciating assets, the other accumulates depreciating currency. One owns productive capital, the other depends entirely on wages. One benefits from monetary expansion, the other reacts to it. Most people blame individuals. Architects study incentives, because incentives explain behavior more consistently than opinions ever can. The Cantillon Effect is ultimately an incentive system. It quietly encourages ownership over consumption, assets over liabilities, capital over cash, participation over observation. Once you recognize this architecture, you stop asking why wealth seems to concentrate. You begin asking how monetary incentives naturally encourage that concentration. That single shift transforms economics from a collection of disconnected events into one coherent system. Because systems never produce random outcomes, they produce outcomes consistent with their design. And the design of money determines far more than the value of currency. It influences the distribution of opportunity itself.
Every complex system reveals its priorities, not through speeches, not through promises, but through incentives. Money is no different. Most people spend their lives trying to earn more money. Architects spend their lives trying to understand where money is going, because direction creates opportunity. Imagine standing beside a river. Most people focus on the water passing in front of them. Architects walk upstream. They want to know where the river begins, who controls its flow, and why it follows a particular path. The monetary system operates exactly the same way. The question is never, where is money today? The real question is, where will newly created capital flow tomorrow? Because tomorrow's wealth begins where tomorrow's capital arrives first. History has repeated this pattern countless times. Industrial revolutions, railroads, electricity, automobiles, the internet, artificial intelligence. Every era experienced different technologies, but the architecture remained remarkably consistent. New capital entered the system. Early participants accumulated productive assets. Asset prices appreciated. Late participants paid higher prices. The mechanism changed. The architecture did not. This is why great investors often appear lucky. In reality, many simply understood where capital was moving before everyone else noticed. They weren't predicting the future. They were reading the incentives already shaping it. Architects understand another principle. Cash is temporary. Ownership is enduring. Currency can be expanded. Productive assets cannot be created with the same speed. Businesses, infrastructure, energy, technology, intellectual property, scarce land. These are productive systems. As new money competes for limited productive assets, their value naturally adjusts. The objective, therefore, is not merely to accumulate currency. It is to accumulate ownership inside systems that continue creating value regardless of monetary expansion. Once this principle becomes clear, financial headlines begin losing their power. Daily market noise becomes less important. Short-term volatility becomes easier to understand. Because beneath every boom, every correction, every crisis, and every recovery, the architecture continues operating exactly as designed. Most people chase income. Architects accumulate productive assets. Most people react to inflation. Architects position themselves before monetary expansion reaches the broader economy. Most people ask how to earn more. Architects ask where capital will flow next. That difference appears small. Over decades, it becomes extraordinary, because wealth is rarely created by working harder than everyone else. It is created by understanding the invisible architecture that determines where opportunity arrives first.
The greatest financial advantage is rarely information. It is understanding. Most people spend their lives reacting to economic events. Architects study the systems that make those events inevitable. The Cantillon Effect teaches a timeless lesson. Money is never injected everywhere at once. It always enters somewhere first. It always follows a path. It always changes incentives before it changes prices. That is why the most important question is not how much money exists. It is, where is the new money going? Because wherever new capital flows, opportunity usually follows. This does not mean every investment will succeed. It does not mean every monetary expansion creates prosperity. And it certainly does not mean wealth is guaranteed. No economic principle offers certainty. The objective is not prediction. The objective is understanding. Understanding how liquidity moves, how incentives evolve, how purchasing power shifts, how ownership compounds. Once you understand those mechanisms, you stop seeing inflation as merely rising prices. You begin seeing it as the visible consequence of invisible monetary architecture. You stop asking, why are assets becoming so expensive? You begin asking, why is capital flowing toward those assets? You stop chasing money. You begin positioning yourself where productive capital is likely to accumulate. Because throughout history, currencies have changed, governments have changed, technologies have changed, markets have changed. But one principle has remained remarkably consistent. Those who understand the architecture of money usually recognize opportunity before the crowd. Most people work inside the economy. Architects study the design of the economy. Most people focus on income. Architects focus on ownership. Most people save currency. Architects accumulate productive assets. Most people wait for the future to arrive. Architects position themselves before the future becomes obvious, because wealth is rarely engineered by earning more than everyone else. It is engineered by understanding where value is created, where capital is allocated, and where incentives quietly reshape the world before headlines ever notice. This is ASUTSEN, architecting wealth, automating future.